Hey, this is Yossi. I run a small investment firm that specializes in REIT investing, and today I have some bad news to share regarding Realty Income, also known as O Stock or the monthly dividend company. Now, you may recall that last year I shared a video entitled Very Bad News for Realty Income, in which I explained why I thought that Donald Trump's victory in the presidential election was very bad news for the stock. And it really boils down to tariffs. I think that tariffs have the potential to hurt Realty Income in two ways. Firstly, I think that tariffs are very likely to accelerate inflation, but unfortunately for Realty Income, it only has about 1% annual rent escalations in its leases. So what this means is that the real purchasing power of its revenue is likely to decline over time. And we see it already now with its guidance for 2025. It has guided to grow its FFO per share by 1.4%. And so I wouldn't expect much more growth in its dividend either, since they want to keep their payout ratio low. I think that inflation will be quite a bit more than 1.4% this year. And so if you're a retiree and you own Realty Income, this is bad news because it means that your income is going to lose in purchasing power. Then the second way how tariffs are going to hurt Realty Income is that Realty Income has a lot of tenants that are in retail categories that are very heavily impacted by the tariffs. It's particularly heavily exposed to pharmacies and dollar stores, which I think will suffer a lot from this. And so in that sense, I think that whatever tenant issues it has been dealing with will now get a lot worse as a result of Donald Trump's latest tariff announcements. In today's Realty Income stock review, I'm going to discuss all of this, what it means for the future of the company, and I will conclude by giving you my latest rating for the stock. Would I buy it, hold it, or even sell? And finally, I will also highlight some other alternatives in its peer group that I think are potentially even more attractive. I will get right into it, but before that, can you please show me your appreciation by clicking the like button and subscribing to the channel? As you can see, I'm traveling right now, but I'm still trying to produce all this free content for you, and your like would really help me a lot. Thank you very much. Okay, so tariffs are very bad news for Realty Income's tenants, and that's because it's very heavily exposed to categories like pharmacies and dollar stores. If we now look at its top tenants, I'll put a chart on the screen, you'll see that its second, third, and fourth biggest tenants are Walgreens, Dollar General, and Dollar Tree, and all of these companies will be very heavily impacted. Let's start with pharmacies. So pharmacies like the Walgreens have already been suffering now for years because the sector has been oversupplied, and we have had big players like Amazon move into it as well, increasing the competition. And so Walgreens have had a lot of properties lose money already before tariffs. This has caused its share price to crash. It has forced the company to close down a lot of stores all over the US. And its problem have gotten so severe that in a recent interview with Agri Realty, we learned that the CEO of Agri Realty is actually expecting Walgreens to file for bankruptcy sometime in the future because that's the only way how it can get rid of its money-losing stores. It's stuck into long-term leases, and it might need to go through a bankruptcy process to get rid of those assets. I think that whatever problems they were dealing with will now get a lot worse as a result of these tariffs, because these pharmacies are importing a lot of cheap products from countries like China. China was just imposed a 104% tariff by President Trump. So these tariffs are massive. It could more than double the price of some products. And yet, a lot of these pharmacies also, a lot of their clients are low-income households that probably will not be able to pay for these big price increases. And so I think that it will lead to a lot more pain for these pharmacies, which are already oversupplied to start with. And so this is the second biggest tenant of Realty Income. If we now get more news of, pharmacies closing down or Walgreens potentially down the line even going bankrupt, I think that this will have a very severe negative impact on the market sentiment of Realty Income. Then when it comes down to dollar stores, I think that they could potentially be even more heavily impacted because most of their client base are low-income households. They cannot really afford a significant price hike, and yet a lot of the products sold in these dollar stores are coming from China and other foreign countries where labor and manufacturing cost is a lot cheaper to be able to offer these low-cost products. I think here that Dollar General is less impacted than Dollar Tree because Dollar General has positioned itself more as a grocery store. A lot of food is being sold there. However, Dollar Tree is selling a lot of discretionary consumer products, and these are coming from China to a big extent, and so they could suffer a lot. And unfortunately, just like Walgreens, they have already been suffering a lot in recent years. They were planning to close about 1,000 stores in the near term, and its problems will now only get worse. And the CEO of the company just recently announced that he was going to step down. One of their main rivals, called 99 Cents, has already filed for bankruptcy. This doesn't necessarily mean that the Dollar Tree is going bankrupt. I don't think so. But it will likely lead to more pain, more store closures, and so this will weigh negatively on the market sentiment of Realty Income. Here you may ask yourself, why doesn't Realty Income simply sell these properties to lower the exposure? And I wish it was that simple, but the problem is that the market is not stupid. It knows that these properties have become a lot riskier, and as a result of this, it has now priced them at materially higher cap rates. Just in the recent month, I've run across a few listings for Walgreens net lease properties with cap rates in the 8th, and before these recent struggles, I had never seen Walgreens with such high cap rates. It was really rare, but now we're starting to see it more and more. I'll put a few examples on the screen here. And so what this means is that if Realty Income decided to sell these properties, it would likely need to reinvest this capital into lower yielding net lease properties. So it will be dilutive to its FFO per share, which will only slow down its growth even further. And as I mentioned earlier, it has guided to grow its FFO per share by just 1.4% this year. And so it cannot really afford to do much of this type of capital recycling, as its growth would suffer even further. So with that in mind, is Realty Income today a buy, a hold, or a sell? And it's a tough question to answer, because on one hand, it is dealing with growing tenant issues, and I think that those tenant issues will only get worse now as a result of these massive tariffs on countries like China. Again, Realty Income is heavily exposed to these retail categories that are the most heavily impacted by these tariffs. So this is very bad news. But on the flip side, the stock is already heavily discounted. I mean, it has dropped significantly as a result of these tariff announcements. And so to an extent, you could argue that it's already priced into the stock. Realty Income is today also trading at a steep discount relative to many of its peers. So the market has been able to price this into the stock to some extent. However, if you really think that a company like Walgreens will file for bankruptcy down the line, I think that we could see quite a bit more downside, and because this will hurt the market sentiment of the stock. And as I said earlier, the CEO of Agri Realty thinks that this company will have to file for bankruptcy. And as a reminder, he is one of the most knowledgeable investors when it comes down to Walgreens, because it used to be their biggest tenant at one point, representing a very significant portion of their revenue. And they decided to proactively sell a lot of these properties because they saw the problems coming. And now in hindsight, we can see that they were right to do so. And so when they tell us that they expect Walgreens to go bankrupt, I take it very seriously. And again, that was before the tariffs. So now after the tariffs, things will get a lot worse potentially even for them. So tough one. I probably wouldn't buy it myself, given that the company is dealing with this growing headwind that's likely to slow down its growth as it's forced to sell assets, it's dealing with more and more tenant issues. Meanwhile, there are some better opportunities in its property sector, in my opinion. If you now think of net lease REITs, there are quite a few that are better protected from inflation, as an example. Therefore, I wouldn't give a buy rating to the stock. I wouldn't give it a sell either, because the market has been smart enough to price this growing risk into the share price. It's now offered at 12 times FFO, a 6% dividend yield. I think it's a reasonable valuation given the growing difficulties that the company is facing, but it's not particularly expensive either, and therefore I wouldn't give it a sell, neither a buy. I think it's a hold at the current valuation. The stock could also enjoy some upside if and when interest rates return to lower levels, so this is a potential positive catalyst if we now go into a recession. But instead of buying Realty Income, I think that some of its close peers are quite a bit more attractive today, especially for today's rapidly evolving environment with major tariffs, a potential recession down the line, accelerating inflation. We can talk here as an example about WP Carey or VICI properties, which are both net lease REITs that enjoy CPI-based rent adjustments. And so because of this, they will be much better protective if now inflation accelerates as a result of tariffs. This would likely accelerate their future growth prospects, and yet their valuations today are fairly similar to that of Realty Income, with dividend yields at right around 6%. Then if you want to really play defense, Then there are also some net lease REITs that own higher quality properties, and yet they're also discounted. Agri-Realty here comes to my mind. It's mostly focusing on service-oriented retail categories. It has little exposure to pharmacies. 2/3 of its tenants have an investment grade rating, so about 2 times more than that of Realty Income. But unfortunately, this is somewhat reflected in its valuation, so its upside potential might not be quite as significant as that of Realty Income if things go well for them. Then we can also talk about NNN REIT here. This is perhaps the best opportunity, in my opinion, in this property sector today in the US, because it's a similar blue chip style net lease REIT as Realty Income in that it has a strong investment grade rated balance sheet and a multi-decade track record of significant dividend growth with no interruption, not even during the great financial crisis, not even during the pandemic. It has kept hiking its dividends for, I think, 35 years in a row, so even a longer track record than Realty Income. And the nice thing today is that it's not as heavily exposed to these struggling retail categories like pharmacies and dollar stores. Yet its valuation, again, is very similar to that of Realty Income. It's also not dealing with the size issue that I've often discussed in other previous videos. I think that Realty Income is becoming too big for its own good, and it's now starting to lead to diseconomies of scale. So NNN REIT is not dealing with that yet at its current size, but it's still large enough to be well diversified and enjoy some economies of scale. Yeah, and so I just think that there are better opportunities in the net lease property sector today, and so I don't really see the point of buying Realty Income. I think that Trump's major tariff announcements are very bad news for the stock. The stock has come down as a result of it, but it could potentially lead to more bad news down the line now if we see more store closures for pharmacies, dollar stores, and other impacted retail categories. That's all I had for you today. Let me know what you think of Realty Income. Again, if you could click the like button, that will help me a lot. Subscribe to the channel. I'm planning to post a few REIT CEO interviews on the channel over the coming month. Just recently, I got to talk with the CEO of Easterly Government Properties as an example, also with the one from New Lake Capital Partners, and there will be many more. Finally, if you want to access my full portfolio and all my real-time trade alerts, you can join me for a 2-week free trial at High Yield Landlord. It will be the first link in the description of this video. This will give you immediate access to my full portfolio. You won't be charged anything in the first 14 days. If the service is not for you and you don't see the value, you can simply cancel. Again, you won't be charged anything. Thank you very much for the support. See you at my next one. Bye-bye.